Hey folks, hope you all are doing well. I'm Karan Bandal from Econosite, and in this video, let's talk about India's rise above China and its impact on ETF returns. To begin, what are the ETFs? In a nutshell, ETFs or exchange traded funds are securities or investment vehicles that can be used to build a financial portfolio. In India these days, not enough, but a growing number of people are investing in mutual funds through SIP, that is Systematic Investment Plan. Indian mutual funds currently have over 71 million SIP accounts through which investors regularly invest in Indian mutual funds. Now, ETF is a type of pooled investment security that operates much like a mutual fund and holds multiple underlying assets rather than only one, like a stock does. Typically, ETFs will track a particular index, or sector, or commodity, or even a nation's economy. For example, US investors can invest in Japan's economy through an ETF that goes by the symbol EWJ, and it tracks the primary stock indexes in that particular foreign country. Similarly, there are ETFs that track the performance of India's financial markets as well. Encouraged by India's robust economic growth post-pandemic, investors are turning their attention to India, and financial analysts are now trying to figure out if now is the good time to invest in India ETFs. Recently, India not only overtook China as the world's most populous nation, but has also seized China's long-held title as the fastest growing large economy. China's economy is tipped by the World Bank to expand by just 4.4% next year, its weakest rate since 1990, excluding the COVID pandemic, of course. China is currently reeling under a property crisis, weak export growth, and geopolitical issues. By contrast, India's economy shows no sign of a slowdown amid a consumer boom with a growth of 6.3% expected this year. Global investors have taken note of the shifting winds. Foreign investment is being channeled out of China and into India in anticipation of richer pickings. Just look at these numbers. Roughly half of the $250 to $300 billion of overseas money that flooded into Chinese bonds because of their inclusion in various indices since 2019 has now exited. On the higher end, that's an outflow of almost $150 billion from China. At the same time, foreign ownership of Chinese equities has fallen by more than $100 billion. Also, in one of our recent videos, we talked about how wealthy Chinese are leaving the country with their capital. That's another $150 billion worth of money exiting China this year. So, $400 billion of capital outflow can leave quite a dent even in a large economy like China's. In India's equity market, money has been heading in the opposite direction. There was $15.5 billion of foreign inflow in the first 8 months of this year. Soon, overseas investors' enthusiasm may spread to the country's fixed income market, that is the bond market, because India is due to be added to the most widely followed emerging market bond index next year, a move that should drive $30 billion of foreign inflows into its government bond market. That means roughly a 10% of the outflow from China is expected to come into India. At least for now, the divergent trajectories are evident for the two economies. One economy has cyclical and structural tailwinds, the other has cyclical and structural headwinds. And India, being a consumption-driven economy, is relatively immune to what happens in the rest of the world, i.e., to the projected global slowdown. Also, India's demographic bulge started much later than China's and is forecast to continue until 2050s. As a result, India now commands a young, growing workforce as opposed to a declining, aging population in China. Indian consumption is expected to more than double, from $2 trillion in 2022 to almost $5 trillion by the end of the decade. Because of all this, India can fill the gap that China's slowdown is creating. And in a slowing world, global capital is seeking a growth story. For the foreign investors wanting a passively managed exposure to this economy, the largest India-focused ETF is the US-listed $6 billion worth iShares MSCI India ETF. It is a market cap weighted fund with 122 large and mid cap companies. It is not the only India focused ETF though. Alternatives like Wisdom Tree India Earnings Fund, Franklin FTSE India ETF, and so on are also available. The key question is, however, will this projected economic growth in India translate into robust returns for the overseas investors? Or has India's better story been largely priced in by now? For example, the iShares MSCI India ETF has already returned a cumulative 8.4% over the past year, 48.9% over 5 years, and more than 120% over the past decade. By contrast, the China ETF has returned relatively nothing, especially over the past decade, and lost money over the past 5-year time frame. See, a 2013 study by London Business School academics found a negative correlation between economic growth rates and equities returns, suggesting that investors would have been better off investing in the most sluggish economies. The researchers behind the study speculated that this counterintuitive thing happens because investors appear to routinely overpay for the growth. Simply put, if you overpay for something, you are rarely going to make a profit on it. Just look at the valuations of the two markets. Equity valuations are stated in terms of ratios, usually the price to earnings ratio. The higher the ratio, the more expensive the stock. India's equity market now trades on a forward price to earnings ratio of 22 as opposed to just 9 in case of China. Also, the price to book ratio of Indian market is much higher than that of China. With such rich valuations, will Indian equities continue to deliver going forward is the question for the investors. But one thing is clear, the long-term trends are moving in India's favor. Just as it took decades for China's rise to materialize, the transformational changes in India are going to take a good amount of time. In summary, India's economy stands out since it is the only one with some growth momentum, as the growth engine of the world, that is China, struggles to find stability. Naturally, investors are looking to India for desired returns. Maybe in the short term, Indian equities may not deliver, but in the long run, looking at India's structural strengths, I think Indian equities will do just fine. I hope you found this analysis interesting. I'll speak with you again next week. Until then, take care.